Imagine having money sitting in your pocket or your bank account, just waiting. But what if that money could grow while you sleep? That's exactly what investing is all about. It might sound complicated at first, but once you understand the basic idea, it becomes surprisingly simple. Today, we're going to break down investing in a way anyone can understand. By the end of this video, you'll know how money works for you instead of just you working for money. Why investing matters. Most people think the only way to grow their money is by earning a higher salary or working overtime. But here's the truth. Earning more money is only part of the equation. Investing allows your money to multiply, so even if you're not actively working, your wealth can grow over time. Think of it like planting a tree. You plant a seed, water it, give it sunlight, and patiently wait. Eventually, it becomes a tree that bears fruit every year. Investing works in the same way with your money. The basics of investing. At its core, investing is simply putting your money into something that has the potential to grow in value. That something could be stocks, bonds, real estate, mutual funds, or even small businesses. Every investment comes with a risk. Some are safer but grow slowly, and some are riskier but have the potential for bigger rewards. For example, imagine you lend money to a friend who wants to start a small business. They promise to pay you back with extra money for letting them borrow it. That extra money is similar to what investors earn when they put their money into stocks or bonds. The idea is that your money works for you while you focus on other things in life. Understanding stocks. Stocks are one of the most popular ways people invest. When you buy a stock, you are buying a small part of a company. If the company grows and becomes more valuable, your stock becomes more valuable too. Think of it like owning a tiny slice of a very big pizza. If the pizza gets bigger, your slice also gets bigger. But here's the thing. The value of stocks can go up and down every day. That's why some people feel nervous about investing in stocks. The secret is to think long-term. Historically, stocks tend to grow over time, despite short-term ups and downs. Understanding bonds. Now let's talk about bonds. Bonds are a bit different from stocks. When you buy a bond, you are essentially lending money to a company or the government. In return, they pay you interest over time, and when the bond matures, they return your initial investment. Bonds are usually less risky than stocks, but don't grow as fast. Think of bonds as a steady and reliable stream of income, like a slow but consistent river. The power of compounding. One of the most powerful concepts in investing is compounding. Compounding is when your money makes money, and then that money also makes money. For example, if you invest $100 today and earn 10% a year, in the first year you'll have $110. In the second year, you earn 10% not just on $110, but on $110, which gives you $121. Over time, compounding can turn small investments into large amounts, almost like magic. This is why starting early is so important. The sooner you invest, the more time your money has to grow and compound. Even small amounts can become significant over years or decades. Diversification. Don't put all your eggs in one basket. One common rule in investing is diversification. This means spreading your money across different types of investments so that if one investment doesn't do well, others can help balance it out. Imagine you have 5 different baskets, and each basket has a mix of eggs. If one basket falls, you still have eggs in the other baskets. Diversification helps protect your money from big losses. Risk and reward. Investing is a balance between risk and reward. Higher risk can mean higher potential returns, but it also means you could lose money. Lower risk usually means smaller but safer returns. The key is to understand your comfort level. Some people are okay with bigger risks for higher rewards, while others prefer safety and steady growth. The important part is making choices that match your financial goals and personality. Long-term thinking. One of the biggest mistakes new investors make is thinking about short-term results. Investing isn't about getting rich overnight. It's about steady growth over time. If you think of investing like planting a tree, you wouldn't expect it to give fruit the next day. Patience is one of the most important tools for successful investing. Investing for your goals. Investing isn't just about making money for the sake of money. It's about achieving your goals. Maybe you want to buy a home, pay for your children's education, retire comfortably, or travel the world. Each goal has a timeline and risk tolerance. Short-term goals may require safer investments, while long-term goals can take advantage of higher growth options like stocks. Common mistakes to avoid. There are a few mistakes beginners often make. First, don't invest money you can't afford to lose. Second, avoid making emotional decisions based on market swings. Third, don't follow tips blindly. Always understand where your money is going. And lastly, avoid trying to time the market. Even the most experienced investors can't predict exactly when stocks will rise or fall. How to start investing. Starting to invest doesn't have to be complicated. Begin by setting aside a small portion of your income for investing regularly. Research investment options and choose ones that match your goals and risk tolerance. Many people start with simple tools like mutual funds or index funds, which provide instant diversification and professional management. Over time, you can explore stocks, bonds, real estate, or other opportunities as your knowledge grows. The importance of learning. Investing is a lifelong journey. The more you learn about it, the better decisions you'll make. Read books, watch videos, and follow reliable financial resources. Don't rush, and don't be afraid to ask questions. Knowledge is your best tool in building wealth. The mindset of successful investors. Successful investors share some common traits. They are patient, disciplined, and willing to think long-term. They understand risk and don't panic when markets fluctuate. They also continue learning and adjusting their strategies over time. Remember, investing isn't about luck. It's about consistent action and smart decisions. The future of your money. When you invest wisely, your money starts to work for you. Over time, this can lead to financial freedom, meaning you don't have to constantly trade time for money. You can pursue the life you want, whether that's traveling, spending more time with family, or starting your own business. Investing can be the bridge between where you are now and where you want to be. Investing is like planting seeds today to enjoy a beautiful forest tomorrow. It may take time, patience, and care, but the rewards are worth it. Every small step you take now can lead to financial growth that changes your life in ways you can't even imagine. Start your investing journey today and watch your money grow while you focus on living your best life. So, if you've been waiting for the right time to start investing, the best time is now. Start small, stay consistent, and keep learning. Your future self will thank you. Don't let fear or confusion stop you from building your wealth. Take the first step today. And if you found this explanation helpful, hit the like button, subscribe for more finance insights, and share this video with someone who wants to make their money work smarter, not harder.